The minutes of the Federal Reserve's April meeting revealed a June rate hike is unlikely. Statements from central bankers are scrutinized extra carefully this year as the Fed looks to hike short-term interest rates, which have remained close to zero for over 6 years now. All right, let's get straight to Michael Hanson, a senior U.S. economist with Bank of America Merrill Lynch, for more analysis. And Michael, what's your take on the Fed largely being against a June liftoff?
So I think it was an acknowledgement that they kind of ran out of time to get enough good data, given that the Fed is now data dependent, to justify a June liftoff. So, I mean, there were a few members who thought they still could get there, but I think the general consensus in the committee is first quarter was kind of soft. We're going to wait and see if things get better. We think it will. So June's just a little too soon. I don't think they've ruled out rate hikes for the rest of the year by any stretch of the imagination. I think September is still very much alive. December, maybe a possibility if things disappoint. But June just seemed too soon.
All right, and just to play the other side here, I mean, the Fed doesn't want to be accused of keeping rates too low for too long, which some investors are already saying is happening, right?
Yeah, I mean, there's certainly people who have been saying that for years now, to be perfectly honest. Fed officials acknowledge those risks. Interestingly, they said they thought that the financial stability risks and their objectives to get the economy back up and running were actually complementary, which I think some investors would disagree with. But I think generally speaking, the Fed is not in a rush. That's the message we've gotten out of Fed officials for quite some time now. I don't think the minutes change that assessment.
All right, now why is the Fed worried that a small rate hike, perhaps 25 basis points, will trigger a surge in other rates?
Well, they obviously have the experience of the taper tantrum, which wasn't even a change in policy, which is a change in communication. So they are a little nervous that when they start going, you could get an outsized move in the market. You've had several Fed officials, New York Fed President Dudley in the last couple of weeks, identify this as a risk. They're aware of it. They said in the minutes they're hoping that the combination of clear communication and a signal of a very gradual normalization process will hopefully minimize those risks. But, who knows what's going to happen? They've got to, I think, be prepared for that possibility.
All right, and does this hesitancy mean they'll hold off on a rate hike even longer, perhaps into 2015?
There's certainly that risk, but I think the data need to disappoint. I mean, what the top line statement from the Fed that I read was, yeah, things were a little soft in the first quarter, but we're not overly worried about that. There are some possibilities things could get worse. We'll need to see the data, but right now they still expect inflation is going to get back to 2%. They still think growth is going to get back and allow them to hike this year. So I think things have to deteriorate further for the Fed to be putting off rate hikes this year. I don't think the threshold to hike is all that high when it's all said and done.
All right, and just real quick, when the Fed does hike, its effect on the markets will be?
I think you're going to get a modest sell-off, and I think it really depends upon communication around it. If the Fed makes it very clear that they're normalizing policy to eventually get back to longer-run objectives and they're not trying to undermine the recovery, and the market gets that message, we're not going to have a major sell-off. If the Fed fumbles that message, it could be a little more ugly.
All right, we have to leave it there. Michael Hanson, a senior U.S. economist with Bank of America Merrill Lynch, thanks for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.